Hi everyone, Shab with another video. Today I'm going to be talking about 3 Dividend Aristocrats that are trading below fair value that I think are potential buys right now based off their intrinsic valuation calculations. So first off, I want to say why I like Dividend Aristocrats to invest in, because a lot of the stocks I talk about here are growth stocks, but there are a couple of clear reasons. Over the long term, they give market performance or slightly better. They're foundational picks, but crucially they give market performance with less volatility. Some may say they're boring stocks. I think they're sleep at night stocks. If you have a decent allocation in your portfolio to these type of stocks, then when growth stocks are falling from the sky, it's not so bad. They're also, most of them are effectively recession proof and have stayed financially healthy throughout many economic recessions and downturns and continue to grow the dividend throughout these in any market conditions, meaning they're essentially safe as houses. First on the list is 3M, the industrials conglomerate, very well known company around the world. Dividend king, not just a dividend aristocrat, 64 years of consecutive dividend growth. Dividend yield of 3.7% as we speak, and currently its payout ratio is around 58%. So not a little on the high side, not too bad, not too high, not too low, not something to be overly worried about. The has a pretty good balance sheet, so I'm pretty confident they can continue to pay this dividend over the long term.
3M is a mega cap company being over $100 billion in market cap, has excellent revenue diversity, present across a ton of diverse industries, hundreds of popular brands like Post-it, Scotch, Scotch-Brite. They produce N95 masks, Command, whole host of non-consumer facing brands as well. They're an absolute titan in the safety and industrial industry, being $11.7 billion a year. Too much to go into any depth in any three areas. I just left it off. If you want to pause it, feel free. They have just tons and tons of diversity here. Only a major financial depression could feasibly taint 3M's revenues due to its supreme diversity, which is why it's been able to pay a dividend for over 100 years consecutively and why it's been growing it for 64 years. 3M stock was a bit of a rollercoaster this year. It was a high of $208 in June 2021. It's down 22.5% since those highs. They were now in February 22. It's sitting around $160, so 22.5% down. Actually, it's underperformed the market, and not only that, it was down 10% this year. Still consistently paid its dividend, and to be honest, there was not much going on here other than the whims of the market. Not too much bad news on the 3M front. Down $160. It's been hit quite by the supply chain issues, but not so much that it requires this much of a drop in my opinion. Look at the margins and some basic valuation metrics. Margins here are really strong. They have a return on equity percentage of 42%, which is absolutely excellent, and return on assets of 12.5%, which again, absolutely excellent. Operating margin of nearly 22%, really strong for the industrials industry. Actually pretty weak versus 3M's history, perhaps because of the supply chain issues. And a net margin of 16.75, meaning they take home 16.75 cents per dollar of revenue and net of tax and everything like that. Pretty good in my opinion. Looking at the valuation metrics and basic valuation metrics, P ratio of 15.8 under the S&P 500 average indicates undervaluation based on the fundamentals in my opinion, and undervaluation versus peers. Price to cash flow again, reasonable at only around 16. Some of the cheapest metrics you're likely to see here for 3M. Some of the cheapest metrics you've ever seen in its history, as you can see on the right hand side. So from these fundamental valuation techniques, it looks pretty cheap in my opinion. So next up is to do a DCF and calculate the fair value. I've used free cash flow for this metric because the EPS numbers are a bit all over the place. 10-year free cash flow growth rate is 7%. This seems realistic for 3M's future in my opinion. Using this and an 8% discount rate for the long-term returns to the stock market, this gave a fair value of $169 compared to a current present-day stock price of $159. I don't think this difference is so big that it's a screaming bargain, but it is saying that this is a company that's trading at fair value, has a tremendous dividend track record, and it's a very recession-proof conglomerate in my opinion. I think this is excellent value for a company that can feasibly grow its free cash flow at 7% per year. This is really strong value in my opinion. Next on the list is Stanley Black & Decker. Again, another household name, manufacturer of industrial tools and household hardware, ubiquitous company, really well known, so I don't need to explain to you what it does in great detail. A dividend king, again, not just a dividend aristocrat based in the industrial sector. 54 years of consecutive dividend growth, really impressive. 1.9% yield as of today, and at just a 30% payout ratio, so there's real scope for this dividend yield to increase in my opinion. I definitely don't consider Stanley Black & Decker in that boring industrial section with that as a low growth as the dividend aristocrats are often associated with. Stanley Black & Decker has a really lot going for it and some tremendous tailwind. There's a lot of brands that will be found on any building site, with any tradesman and in most households. DeWalt, Craftsman, Stanley, Power Stack, Black & Decker, Cub Cadet, they're everywhere, absolutely ubiquitous. Long-term tailwinds in the form of upcoming potential infrastructure bill in the US, $1.2 trillion bipartisan US infrastructure bill that who knows when that's going to happen or if that's going to happen. But if it does, this tremendous tailwinds. Also, the lack of homes in many countries, particularly in the US and the UK, for example. Low existing inventory means there's going to be a demand for tools as people would rather improve their own house than move, build extensions and things like that. And that is just going to be a tremendous tailwind for Stanley Black & Decker as we go forward. And it's growth for EPS, it's growth for free cash flow, it's growth for dividend. Like 3M, almost identical to 3M actually, this is a company that reached its peak in May 2021 and is down 26% from its highs, now sitting at $162. Again, lost the market last year, down 7%. Didn't really underperform, some supply chain challenges as you would expect with most industrial companies. As these ease in the next year or two, or hopefully this year, you'll see Stanley Black & Decker coming with these tailwinds. You can see it firing back. Looking at the margins and profitability and some valuation measures, again, you're seeing a comment here. Excellent profitability. Net margin of 10% in the heavy industrials industry is really strong in my opinion. Some of the best performance that Stanley Black & Decker has ever done for its history. Same with the operating margin. Return on equity of 15%. Not as strong as 3M, but still very strong. 3M's was just outrageously strong. Very strong for the industrials industry and very strong for Stanley Black & Decker's history. Return on assets of around 7%. Again, strong for the industry, really strong for Stanley Black & Decker's history, so you can see management are really executing on this profitability standpoint. Looking at the valuation metrics, again, PE of just under 16, forward PE of just about 13.5, significantly under the S&P averages, indicating that this company is misvalued versus its peers and is undervalued based on fundamental techniques. Price of free cash flow, 186. Free cash flow is a bit skittish with this company because they've decided to spend a lot this year on some capex and some investments, so I'm not going to ding them too much for that. Normally I'd prefer to use free cash flow for a mature company, but this time I'm going to use EPS because again the free cash flow measure is kind of all over the place because the investments they've been doing recently and putting money back into the business. Using the perhaps pessimistic 5-year average EPS growth rate of 6.4, so the 10-year average is 10, but I just try and be conservative in some of these calculations. This gave a fair value of $163 versus the current stock price of $162, again using the same discount rate of 8% for the long-term returns of the stock market. Obviously, this is a conservative estimation, and even then, the stock is trading at pretty much fair value. A reasonable buying point, in my opinion, perhaps, if you have perhaps a brighter outlook on Stanley Black & Decker, which I happen to do, I just prefer conservative models, then you can imagine that this is way below its intrinsic valuation and a significant discount to fair value. This is a rare chance to pick up a dividend king with long-term tailwinds and a good balance sheet, a pretty much fair value, in my opinion, or below. Last on the list, again, another US company, one that many people will be familiar with. Lowe's, consumer discretionary, runs a load of hardware stores, big competitor of Home Depot, 48 years of consecutive dividend growth, so just shy of being a dividend king, and a 1.4% yield as of right now, with just a 24% payout rate, so there's really a ton of room for this to grow. Basically, the yield keeps coming down because the stock has been such a fantastic performer over the long term. As I mentioned, Lowe's has had really strong performance over the long term. Over 100 bagger over its lifetime, 27% beat in the last year, beat the market, down 13% from its highs. So again, perhaps presenting a buying opportunity in the wider decline of the stock market. Really strong performance. This is a company that very rarely is cheap. CEO Marvin Ellison has done a fantastic job since taking over, really taking it to Home Depot and providing reasonable competition. These companies very rarely trade at PE below 20, and I think this is a nice buying opportunity, as we'll talk about in a minute. Looking at the margins of valuation, on the left-hand side, I would expect for a company like this, and it's in constant competition with Home Depot, I'd expect to see weak margins. That is just absolutely not the case. Operating margins 12.36% for a retail company is excellent. Net margin of 8.6, again, for a retail company is absolutely excellent. 8 cents for every dollar of revenue goes into the back pocket of shareholders. Return on equity, just a bit ridiculous there. I don't know what's going on with that. That's clearly a mistake. Return on assets of 16.5%, absolutely excellent. All tremendous metrics for Lowe's history. As I said, CEO Marvin Ellison and his team are doing an absolutely excellent job of really reviving Lowe's. And what never has been a bad investment, really, but over the last 5-10 years, Lowe's has really shined. Looking at the valuation measures, again, as I said, this is a company that very rarely below a PE of 20 or so because it's been such a strong performer. PE of 19.6 right now, a good valuation for Lowe's history outside of recessions. Full PE of 18, again, good valuation for Lowe's outside of recessions. And crucially, below the S&P average, this is a company that has returned more than 100 times. It beat the S&P last year. It provides a good, safe dividend, and and it's trading below the average of the S&P. Just seems wild to me. Price to free cash flow 23, slightly high because it's not. Lowe doesn't have an incredible free cash flow rate, but again, these are really, really strong numbers. PEG ratio of 1.87. We're looking for under 1, really. That would be a bargain, but 1 to 2 is a completely acceptable range, and this is some of the highest, the lowest PEG ratios you'll ever see in Lowe's history. Some of the highest opportunity chances for Lowe's, in my opinion. So time for the DCS. I thought I'd use earnings per share for this because, again, free cash flow is a bit all over the place. We're down 26% this year because of some supply chain challenges and some investments in the stores. So I decided to use 10% EPS growth to be conservative. This is really conservative in my opinion. The 10-year average rate is 16% earnings per share growth, 5-year 19.5%, 1 year 62%, 10%. They're clearly not going to get 62% every year, but 10% I think is conservative for this. For using an 8% discount rate again, 10% earnings per share growth rate over the next 10 years, that gave a fair value of $240 compared to a stock price today of $225. Again, if you perhaps not as conservative as me for these calculations and you believe that they can continue to grow earnings per share at 16%, then this is going to be a stock with a fair valuation of in the 300s, perhaps $400. So this is clearly a fine opportunity to get a stock that is very rarely cheap, that is a long-term returner, and it's a safe stock, safe dividend for below fair value or far below fair value, depending on your outlook. That's the end of the video. I think these three companies are all excellent companies that in a diversified portfolio will provide good long-term returns and will help you sleep at night, crucially. So, but again, none of this is financial advice. So if you want financial advice, you should go to a registered financial advisor. These are just my opinions, and you should, based on my research, and you should do your own research and back your convictions up. With that said, if you like the video, I'd appreciate if you could like and subscribe if you're enjoying the content. See you later.